Right, good day everyone. Welcome back to Accounting Masterclass. We are still on Accounting Grade 12, November 2018 paper. This exam was written on November 2018 and we are currently doing question 4. We are in question 4 and today we are starting on question 4.3. It is advisable that when you are watching this video that you should also have a question paper in front of you. The paper that we are dealing with is November 2018 NSC exam and we are on question 4. Question 4.3 today, and question 4 was based on cash flow statement. Cash flow statement, based on cash flow statement and interpretation. It was based on cash flow statement and interpretation. Right, 4.3, cash flow and financing activities. Then under 4.3, we have 4.3.1. 4.3.1. 4.3.1, it says, explain why the directors are satisfied. Explain why the directors are satisfied with the improvement in the cash and cash equivalents since the 1st of July 2016. Right? If you go to the information that is provided in this question paper, and the information is from page 14 and 15. Right, if you look at the cash and cash equivalents, the opening balance in 2017 is an overdraft of 609,000. So if the opening balance in 2017 is an overdraft, that is telling us that in 2016 we closed with an overdraft of 609,000, because the closing balance then becomes the opening balance. So the closing balance in 2016 was a negative 609,000. But if you look at the current closing balance now in 2018, is a positive 410,000. So when we then go back to the question, where if the question says, explain why the directors are satisfied with the improvement in the cash and cash equivalents since 1st July 2016. So it's clear that the directors should be satisfied, because 2016 we closed. In 2016 we closed with an overdraft. With an overdraft of 609,000. We closed with an overdraft of 609,000, meaning that we had a negative balance in our bank account of 609,000. And now it has improved to an extent that in 2018 we are now closing with a positive balance of 410,000. So in 2016 we closed with an overdraft of 609,000, and there has been a great improvement as we are now closing with a positive balance of 410,000. We are now closing with a positive balance of 410,000 in 2018. So we are saying that there has been a great improvement from 2016 How do we know that we closed with a negative balance in 2016? It is because when you look at information C on page 15, the opening balance for 2017, we know that the opening balance is the same amount as the closing balance in 2016. So 2016 closing balance was 609,000, and therefore we opened with a 609,000 negative in 2017. So we are saying that in 2016 we closed with an overdraft of 609,000, and there has been a great improvement as we are now closing with a positive balance of 410,000 in 2018. So that is why the shareholders are very happy, or they are satisfied with the improvement in cash and cash equivalents. Right, that was 4.3.1. And then 4.3.2, 4.3.2 decisions and gearing in 2018. Identify 3 decisions that the directors made to pay for land and buildings, 6 marks. We want to identify 3 decisions that the directors made to pay for land and buildings. That's 1, 2, 3. 3 decisions. And explain how these decisions affected capital employed, financial gearing, code 2 indicators. But the first thing that we need to do is to identify the 3 decisions that the directors made to pay for land and buildings. So let's go to our information. When we look at the information C on page 15, we can see that the directors purchased land and building to the value of 4,840,000. Land and building was to the value of 4,840,000. 4,840,000. That's the value of the land and building that was purchased. And then the question wants us to supply 3 decisions that the directors made to pay for this land and building. So we need to look closely at our cash flow statement and try to see, to identify the 3 decisions. Where did this money come from? This 4,840,000 that the directors used to buy land and buildings. The first thing that we can see there in our cash flow statement is that there were shares that were issued, share capital issued, shares issued during the year. There were shares that were issued during the year, and we were able to raise 4 million. The 4 million came out from the sale of shares. That's the first decision that we are identifying, where we got the money to buy the land and building. There were shares that were issued during the year, and the amount of money that was received is 4 million. Maybe another thing that we can see here is that there was a fixed asset that was sold, sale of fixed assets. Sale of fixed assets. There were fixed assets that were sold, and we have already calculated that in the previous lesson. That was 4.2.3. In 4.2.3, we were required to calculate the sale of fixed assets. Sale of fixed assets. So another money came from the sale of fixed assets. So there was fixed asset that was sold. So the business was also able to raise money from that. There was also cash. If you look at the cash flow statement, there is also cash flows, cash generated from operations. Cash generated from operations. And the amount is 1,850,000. 1,850,000. The sale of fixed assets here we refer to, that was 4.2.3. Refer to 4.2.3. We have already calculated that amount into 4.2.3. Sale of fixed assets. So these are the three decisions that the directors took in order to raise funds to finance the purchase of fixed asset, which is 4,840,000. They decided to issue new shares, and the amount that we got from there was 4 million. And they also decided to sell fixed assets, and there was also some money that was raised out of that sale of fixed assets. And there is also some cash that was generated from operation. Part of that money was used to buy, because we were able to generate 1,850,000. So part of this money was also used to finance the purchase of fixed assets. So these are the three decisions. The question was asking us to identify three decisions that the directors made to pay for land and buildings for 6 marks. That is still 4.3.2. And there is the second part of this question, 4.3.2, which then asks us to explain how these decisions affected capital employed. We need to explain how these decisions of issuing shares, selling fixed assets, and also there is this cash generated from operations of 1,850,000. So we want to check now how these decisions have affected capital employed. Firstly, one needs to understand how to calculate capital employed. The capital employed is made up of shareholders' equity plus non-current liabilities. That's shareholders' equity plus non-current liabilities. Shareholders' equity plus non-current liabilities. Shareholders' equity plus non-current liabilities equals to capital employed. That's capital employed. Shareholders' equity plus non-current liabilities equals to capital employed. And if you look at let's start with 2017 and then 2018, the beginning and the end. 2017. If you look at the shareholders' equity for 2017, the shareholders' equity for 2017 is 7,191,000. Right, and the loan, the non-current liabilities, is 2,600,000. So the combination of the two amounts will then give you the capital employed, because capital employed is made up of shareholders' equity plus non-current liabilities. And if you look at the capital employed for 2018, you have the shareholders' equity amounting to 12,112,000. 12,112,000 plus loan amounting to 1,850,000. Plus loan amounting to 1,850,000. So let us then have the capital employed for 2017 plus the capital employed for and the capital employed for 2018. So 7,191,000. 7,191,000 plus 2,600,000 plus 2,600,000 equals to 9,791,000. 9,791,000. 9,791,000. And then the second one is 12,112,000. 12,112,000 plus 1,850,000 equals to 13,962,000. So if you are asked a question, how did these decisions affect the capital employed, you can see that the capital employed increased. Capital employed increased. Capital employed increased from The capital employed increased from 9,791,000 to 13,962,000. 13,962,000. That's an increase of how much? 13,962,000 minus 9,791,000. That's an increase of 4,171,000. That is an increase. $4,171,000. Yes. So if you look at the capital employed for 2017 versus the capital employed for 2018, the capital employed for 2018 is 13,962,000. 13,962,000 minus 13,962,000 minus 9,791,000. So that's an increase of 4,171,000. So we are saying that the decisions that were taken by the directors in order to finance the purchase of fixed assets to the value of 4,840,000, the directors decided to sell shares and they raised 4 million. They also decided to sell the fixed assets. They also decided to use some money which was generated from the operations of the business, because we had cash generated from operations amounting to 1,850,000. And then the following question is then asking us as to how this decision affected capital employed. And when we look at the capital employed for 2017 and 2018, we can see that the capital employed increased by 4,171,000. That is from 9,791,000 to 13,962,000. And still on the same question, the B part of this question, they also want us to explain how these decisions also affected financial gearing by quoting two indicators. How these decisions have also affected financial gearing. Quote two financial indicators, and we know the financial indicators relating to risk and gearing. The first one is debt equity ratio, and the second one is return on total capital employed. So let us go and check as to how these decisions affected financial gearing. Let's look at the financial indicators on page 15. Financial indicators on page 15. If you look at the debt equity ratio, the debt equity ratio improved. Debt equity ratio improved from this debt equity ratio improved from 0.4 is to 1 to 0.2 is to 1. Remember that the debt equity ratio, you are looking at the risk here. And you must always remember the formula of calculating it debt equity ratio. It is when we are looking at the loans versus the shareholders' equity. So you can see that in 2017, the loans were too high. If it was 0.4 is to 1, the loans were a little bit high, but it went down now to 0.2 is to 1, which is an improvement. One might look at it that in a way that it is decreasing, but the decrease in the debt equity ratio is indicating that there has been a decrease in the risk of the business. The loans were a little bit high at 0.4 is to 1, and then they went down to 0.2. So this business is now having a low financial risk. And if you look at the return, which is the ROTCE, if you look at the return, which is ROTCE, the return on total capital employed has increased from 17.8%. The return on capital employed increased from 17.8%. 17.8% to 20.8%. Return on total capital employed increased from 17.8% to 20.8%. And is more. It is more than the interest rates on loan. Of 12%. So we are saying there is a positive gearing. Right. So if you look at this, if we can revisit this question 4.3, it's quite of a long question, 4.3.2. There are these decisions that were taken by the directors. And how has these decisions affected the capital employed? We have seen that the capital employed has increased. It means that this decision had positive impact in the business, because the capital employed increased by 4,171,000, and it's also positive that the debt equity ratio improved from 0.4:1 to 0.2:1. And whatever that we are getting from our loans, the return, if you look at the return, because the money that we borrow from the bank, we take it to invest it elsewhere. We are investing it in the business, and the return that we are able to get out of the loan is 17.8%. It was 17.8% last year, and then the return on total capital employed, it went up to 20.8%. This is quite good if it is compared to the interest rate on loan, because we are expected to pay the interest rate of 12% in that loan that we took from the bank. So 12% is less than the return of 20.8%. Therefore, there is positive gearing. So there is positive gearing. If we are asked about the risk and gearing, the risk went down and the gearing is positive. How do we say that the gearing is positive? It is because the interest on loan, we are expected to pay only 12% as an interest on this loan, when we are getting a return of 20.8% from the amount that we are investing in the business, which was taken as a form of a loan. 4.3.3. 4.3.3, it says here, from the cash flow statement, identify one decision made by the directors in 2017 that they did not make in 2018. We want to identify one decision which was made by the directors in 2017 that they did not make in 2018, besides the points mentioned above. Give a possible reason for the decision in 2017. So we need to look at the decisions that the directors made in 2017 that they did not make in 2018. We need to look at the cash flow. Look at something that is reflected in the cash flow statement in 2017, but which was not the case in 2018, because we are looking at the decision taken in 2017 which were not taken in 2018. Like in 2017, we can see that there were no shares, no new shares were issued in 2017. That's the first decision. No new shares were issued in 2017. There is zero there. Under the share capital issued in 2017, there is zero. So no new shares, because we are identifying. Let's read it thoroughly to make sure. Yeah, we want to identify one decision made by that they did not make in 2018. Yes, decisions made in 2017. The first decision we are noticing in 2017 is that there were no new shares that were issued. Under the share capital issued it is 0. And another decision that was done in 2017, which is not the case in 2018, is that there were shares that were repurchased. Shares repurchased. There were shares that were repurchased. Shares repurchased, and the amount of money spent was 1 million, which was not the case in 2018. Yes, there were shares that were repurchased. If you look at 2017, there is 1 million for shares repurchased, but in 2018 that was 0. So that's another decision that we can quote. Another decision we can also quote here is the change in non-current liabilities. The change in non-current liabilities in 2017, we took a new loan for 600,000, but there was no new loan taken in 2018. The only thing that we made in 2018, we paid for the loans for 750,000. So another decision that we can mention here as the third decision reflected in 2017, which was not the case in 2018, is that there was a loan, new loan raised, new loan taken, 600,000. There was a new loan that was taken by the business in 2017, which was not the case in 2018. In 2018, there was no new loan that was taken, and we decided to pay for the loans. So these are the decisions that we can reflect here, because they were asking how many. They said from the cash flow, identify one decision made by the director. It was only one decision. So we can just record only one. But let's leave just only 2 in case, yeah. But the question only wanted one decision. No new shares were issued in 2017. You can get full marks for that, or you may say shares repurchased. There were shares that were repurchased in 2017 for 1 million, which was not the case in 2018. But according to the question, they just wanted one reason. And then they say, give a possible reason for the decision in 2017. Why the possible reason? Let's give just a possible reason for this, for shares repurchased. With what might be the reason for the business buying back shares? It is to keep the shareholders happy. If the shareholder is no longer happy and wants to leave, then the business has got a right to buy back those shares in order to make sure that the shareholder is not frustrated, is happy. So then the business decided to buy back these shares. We want to keep the shareholders happy. We want to save on dividends. Save on dividends. Because if we buy back these shares, then we will not be expected then to pay dividends, because when we are paying dividends, the dividends are paid according to the number of shares that one owns in the business. So if we have repurchased shares, so it means the business is going to save, because the number of dividends will decrease, and that will result to the dividends paid, the amount for dividends paid being low. So the business is going to save on dividends.